Hi there, welcome to Market Call. Our guest is Stan Wong, Portfolio Manager at Scotia Wealth Management. He's taking your questions on North American large caps and ETFs. You can call Stan right now, 1-855-326-6266, or send him an email, marketcall@bnnbloomberg.ca. Great to see you, Stan. Thanks for joining us.
Thanks for having me. Happy 2025.
Same to you. So we have these lingering inflation fears in the States. As you know, the bond yields have been moving up, and that apparently is casting a shadow over U.S. stocks today. But generally, you think the economy looks pretty good?
Well, it seems like good news is now bad news again, with the ISM numbers being a bit stronger and now concerns about potentially rates not coming down as quickly as we hoped. And I've always said that rates can stay higher for longer and inflation might be a bit sticky, but we are still a far way away from about a 9% inflation rate that we had a couple of years ago. I think we're really in a Goldilocks phase. It's not too hot, not too cold type of economy in the U.S. We've got steady GDP. Inflation is still relatively easing or stable. The consumer remains consumer segment remains pretty steady, and the labor market is still pretty stable as well. So I think that gives us that Goldilocks scenario, and corporate earnings remain strong, which is really the most important key. When we look at 2025 and 2026, we see about a 12% earnings growth rate forecasted for the S&P 500, and when you look at mid caps, it's even higher than that. So I think things are still primed for a market in North America and in the U.S. particularly to move higher again this year for the third consecutive year.
A three-piece, yeah. And you note that there's vast amounts of money sitting in money market funds south of the border, which potentially could go into stocks. Yeah,
we've reached $6.75 trillion in money market assets. If interest rates continue to fall, that's just going to provide more support for equities, and it's going to provide a buffer to the economy as well.
I'm sure it varies from client to client, but your basic weighting is 70% U.S. stocks, 30% Canadian.
In our equity component, it's roughly 70% U.S. stocks, 30% Canadian. The U.S. names or the U.S. component has increased over the last few years for obvious reasons. U.S. markets have done really well, and of course, the U.S. currency has moved forward as well.
Yeah, that U.S. dollar, maybe we could put up a one-year chart for the Bloomberg dollar index. It really is. I mean, it's basically the euro and the U.S. dollar are pretty close to parity now.
Yeah, well, when we compare it back to the Canadian dollar, I mean, given the political climate that we're in today, the uncertain economy in Canada, I wouldn't be surprised if the loonie remained pretty weak at this point, and we'll continue to see a 69-70 cent dollar, maybe even lower going forward. When you look at the interest rate differential between the U.S. and Canadian interest rates, that points to further weakness in the loonie relative to the U.S. dollar.
Yeah, because our rates are so much lower now, or our short-term rates anyway. Yep.
Of course.
Stan Wong is our guest on Market Call, Portfolio Manager at Scotia Wealth Management. The topic, North American large caps and ETFs. You can call right now, 1-855-326-6266.